Well, hello ladies and gentlemen, hackers and traders. My name is Dr. J and welcome to the fifth in our series of building a high-frequency trading system. Today we look at the holy grail of algo trading, and that is building the signals that predict the future about the markets. And if we know about the future, we can profitably trade around those predictions to beat the markets, i.e. generate alpha. By the end of this video, you'll have some idea of what signals look like and how they fit into the big picture, how to create your own signals, and how to evaluate whether they'll be profitable or not, or whether they have any predictive power or not. It's going to be big. It's going to be fun. This is hacking and trading. Stay tuned. So what do we mean when we say we want to predict the future? Well, in the case of trading, it's quite obvious that we want to predict whether the price of an asset is going to go up or down, or maybe even just stay the same over the next short while. How far into the future we are predicting is rather important. Making predictions into the next 100 milliseconds is a completely different task to making predictions over, say, the next 10 minutes. Think about it. While zigzagging on a generally upward trend over the next 10 minutes, an instrument's price will go up and down many times over 100 millisecond horizons. And obviously, how far into the future we are predicting is going to affect how often we're going to act on those predictions, and that's going to lead to how often we're going to trade around those predictions, which implicitly means, well, how long are we going to actually be holding on to the things we're buying and selling? So how exactly can we predict the future? Well, before we go there, we have to first consider what information we have at our disposal at the time we're making the prediction. So let's rewind a bit to our last episode where we left off with our market data. Remember that the data that we are receiving from the exchange and recording to disk are essentially the initial snapshot of an order book, then the deltas to that order book as soon as they come in, and or any trades that have happened since the last tick. So in this example, we can see that at 9:43 in the morning of 27th of September, the order book looked like this. There was a bid and an ask of $600 and $660, and no trades had come in the previous tick. Then, 400 odd milliseconds later, the exchange sends us a delta packet explaining that some of the price levels have changed and that perhaps some trades have come in the last short period since the last change of the order book, perhaps. In this case, we can see that the bid level of 100 has changed from 4 to 3. The bid level at 200 has been introduced. Similarly, several things at the ask level. Notice the $1,000 price level has been destroyed completely. And finally, that 3 trades happened since the last tick. 2 buys or 2 trades where the aggressor hit the bid side, and 1 trade where the aggressor hit the ask side. The consequences of that delta update there is that the order book now looks like this. You can see we have the $1,000 level has disappeared. We have a few other levels, and we know that recently these 3 trades just happened. So the best real-time data that we have when trying to predict the future are these kind of books. We have the prices, the best price someone's willing to buy and sell at. We have information about how many people are wanting to buy in total. And we have information about how recently or how frequently people are buying or selling in the market almost in real time. So given those order books, and given that we're trying to predict at this point, we see like here, Bitcoin has been traveling up and down. Well, this looks like Ethereum. Ethereum has been traveling up and down over the last, I don't know, an hour and a half here. And we're at this point where we're trying to decide whether the market's going to go up or the market's going to go down. So the first place we can look is at the Ethereum US dollar book as it stands right now. What's the best bid offer price? What's the depth, i.e. how many people are willing to buy or how many people are willing to sell? How much are they willing to buy and sell? And also how many trades have just happened in the last few milliseconds or seconds. We can also do things like remember a short-term history of the book. Like, has the price gone up a little bit in the last while? Has it gone down a little bit? Is it trending upward? Is it trending downwards? Is the current price higher than it was a second ago? We have that kind of information. We can look at related books, like we might be trading Ethereum US dollar cash instruments, but on the exact same Binance exchange, there's the Ethereum futures book. That's obviously going to be highly correlated to the cash book. Maybe we want to look at that order book as well. And similarly to that extent, there's a USDT book, but also there's the Binance stablecoin dollar BUSD. Let's look at the Ethereum BUSD book as well. Getting into more esoteric things, what about the books on other exchanges? We may be trading on Binance, but why not look at what's happening on crypto.com or Coinbase, or I'll talk about FTX. Okay, so we've been trading Ethereum here, but hang on, Bitcoin is kind of correlated to Ethereum. Certainly if Bitcoin tanks, everything else tanks with it. So why don't we also look at the dynamics around the Bitcoin book? You can see how our universe is expanding of where we're going to be finding information when trying to predict what's actually just going to happen to our Ethereum US dollar cash price. But if we're going to expand just a little bit, well, we've got the whole universe. Why not look at risk-on books like the NASDAQ stock exchange? That seems to recently be quite correlated to the performance of crypto in general. And if not NASDAQ, well, something even more esoteric. How about we look at the sentiment in the news? Natural language processing could give us a sense of whether people are currently bullish or bearish about cryptocurrency today. Similarly, maybe we're scraping Twitter and just looking at the sentiment across Twitter. And finally, maybe we don't need to just rely on what's happening right now in the moment. A lot of signals can look at quite long ago history when trying to determine the future. I'm not sure I'm a fan of them, but certainly there's a huge market of people who really do believe in this stuff. So for example, some people will believe if the market's just fallen, well, there's some sort of mean reversion. It's probably going to rise up again, maybe half as much, and then it'll fall again, and you end up with these sort of refractive waves in the marketplace. If you believe in that stuff, build a signal to take advantage of it. Maybe you want to look at the trade volume, like here you can see trade volume is picking up. Maybe your signal is going to behave differently when there's a high trade volume to when there's very low trade volume. The sky's the limit. Like, really, this is where the gold comes from. You have to look at all the data in the world that's available to you and decide how you're going to capture that into a signal that can predict the future. Whatever the sources of information you choose to use, some are way more relevant to the short end, the higher frequency end of the prediction world, and therefore looking less far into the future, while others in the mid to low frequency end of the spectrum tend to be able to look further into the future. So for example, looking at the Ethereum US dollar book right now can give you a very accurate reflection of what's going on in the market in the last few milliseconds. Similarly, looking at the futures book, other books that are similar stablecoin currencies, these are all at the very high frequency end. Even NASDAQ or exchanges that are slightly far away, well, they have to traverse the world to get that information to you. So you can see you're already getting slower and slower in terms of how relevant and how fresh that data is to very high frequency trading. All the way to the other end is where you're looking at momentum indicators or other technical analysis kind of things, or long-term price history, mean reversion trades. Those tend to be more relevant at the mid to low frequency end of the spectrum, where you're trading less frequently and hoping for a bigger return on those trades. So you can imagine more specifically these little clouds. How many trades were done in the last 500 milliseconds? How many orders, or how many actual trades happened, or how many orders arrived at the market in the last second? These are very high frequency concepts. Whereas things like, well, what was the closing price of NASDAQ yesterday relative to the price right now? There's a couple of hours have passed for that information to filter into the market. What's the 28-day moving average for a price relative to now? These are kind of very low frequency concepts. Needless to say, I'm all about the statistics. I'm not a gambler, I'm not a hodler. I want certainty that my trading is profitable. Now, this doesn't mean that every single trade I do needs to be profitable. All I need is that of the thousands of trades that I do every day, a large enough percentage of them is profitable so that statistically I'm certain of a profit that day. The higher frequency at which we're trading means the more short-term predictions we're going to need. And that means we have more data in the same time period, so we're going to be able to do better and better statistics with that data. We might have tens of thousands of trades or predictions per hour at the high frequency end, whereas only maybe tens or hundreds per hour at the very low frequency end of the spectrum. And obviously, the frequency with which you want to trade is going to directly affect the kinds of signals you're going to be researching and creating. Okay, so here are a few of the things that you might need to consider when deciding whether you want to be doing short-term predictions or long-term predictions. Basically, whether you want to be doing very high frequency trading or lower frequency trading. You need to understand that the frequency of trading that you're going to be doing will seriously influence how much market data you need to have recorded. To successfully build and test signals, you'd probably need about 2 weeks worth of recorded market data if you're doing high frequency signals and analysis. But if you're going to be trading only a few times an hour, well, you're going to need to do back testing that covers several months, maybe even half a year's worth of market data. So how much market data you need is profoundly influenced by the type of trading you want to be doing. So let's drill into some of the differences between short-term high frequency trading and longer-term medium frequency, low frequency trading. Basically, if you're trading very fast, you're obviously going to have a very much smaller potential to make money per trade. The market doesn't move that much in 1 or 2 seconds, so you can't expect to be making 10% on each trade. You're probably going to be making a few basis points. Whereas if you're going to hold on to your position for an hour or two, well, chances are you could earn 5% on that trade. You could also lose 5% on that trade. But interestingly, at the short-term end, your predictions can be more accurate. There's much less noise and stuff creeping into the system if you're only predicting a brief distance into the future, and also you're going to be making more predictions. Low frequency trading, your predictions are less accurate and you're going to be making far fewer of them. Interestingly, when building short-term signals, you're looking more at the microstructure of the market. How many people have just turned up? What's the price doing right now? What have I seen at that exchange? Whereas when you go to the long-term prediction stuff, you're arguing or your hunches are based more on long-term human behavior. Is there a herd mentality? Oh, the Tesla price is going up. Everyone jumps on board. Oh, something bad has happened. Everyone's selling at the same time. So the difference between short-term and long-term trading is often the difference between something very technical and something that's more human emotion related. When doing short-term prediction and trading frequently, you're obviously going to be more sensitive to fees. If you're only earning a few basis points per trade, well, you can't exactly be going and paying 5 or 6 basis point fees for those trades. Slower trading, you're not really that sensitive to fees because you're not trading that often, and the fees are quite small relative to your potential profits. Something that I like about high frequency trading is you have very short holding times. You're only holding some of these very, very dodgy crypto tokens for couple of seconds, maybe 20 seconds maximum. Whereas longer term predictions, are you willing to hold on to some Dogecoin for a day, 2 days? That's just not my bag. And as I say, short-term prediction stuff, it's very sensitive to latency. So you need to have built a very good system, probably in C++, or at least a relatively low-level machine-oriented language, rather than a high-level language like Python or some of the interpreted languages out there. So it's definitely more about technology when you're doing high-frequency trading. For low-frequency, latency is not that important. And again, it's not your technology skills that are that important. It's more your understanding of economics, of human behavior, herd behavior, market behavior. And finally, at the short-term prediction end, you don't need that much historical data, but it's much more difficult to simulate what's going to happen when you start trading. Reason that is at the high-frequency trading end of the spectrum, there are a lot of highly technical algorithmic trading firms out there, all going for the same opportunities. So sometimes the difference between 800 nanoseconds, 1 microsecond, 2 microseconds can be the difference of you managing to get a trade or someone else snatching that trade from under your feet, and you don't actually get that trade. It becomes quite interesting, challenging, compelling to build a simulator that's accurate at the high frequency end. In terms of low frequency, man, it's really straightforward to build a simulator. We're going to go through a simulator in a future video, so subscribe. You want to see that And yeah, you're going to need a lot more historical market data to get sufficient statistics to know whether your algo or your signal is actually profitable. So when we're talking about predicting the future, what exactly are we talking about? Well, in our case, we want to be answering the question, by what percentage is the market going to go up or down in the next few seconds? Well, more specifically, I don't want to use percentages because the market doesn't really move that much in such a short period of time. Well, except when it does and you're screaming into your designer Doge pillow. But instead, we use basis points. Well, it's a percent of a percent, 10 to the minus 4. And specifically, I'm interested in 200 milliseconds into the future, 1 second into the future, and 5 seconds into the future. Why I'm interested in all three horizons will become apparent in one of the later episodes. Okay, so how do we picture actually what we want to be doing here? This is a screenshot of one of the many tools I built to help me do research into signal design. I guess up to now I haven't even mentioned what programming language I'm using. Well, I'm using C++ running on Ubuntu, C++ 17 running on Ubuntu. And this particular GUI is using Qt version 6, I think it was, and Q custom plot. I can really recommend Q custom plot because it can handle million-point data sets with a breeze, and a million data point picture is worth more than 1,000 words, that's for sure. Anyway, the top chart here is the price evolution of Alpha USDT trading on Binance futures at roughly 10:40 in the morning, and we have a trajectory here of about 30 seconds. This particular coin is trading for just around 9 cents. You can see the granularity on some of these exchanges can be like 6 decimal places. And that's going to be important. That's why we use basis points, because when price is only changing in the 5th or 6th decimal place, percentage returns are not that meaningful. We're really down to basis point returns here. The next two charts are examples of how to visualize and debug a signal. Firstly, notice these light yellow areas that are plotted in here. These show what the future returns would be on this historical data set. So in the first case, this is 200 millisecond returns, and in this case is 1 second returns. To understand it more clearly, have a look at this yellow blob here. You can see it starts roughly 1 second before that market dropped. That's telling us at this point, in a second's time, the market's going to have dropped. You can see it then rises again. That's corresponding again to that area there that you can see as a second later. It rises, rises, rises. So essentially, given that there was this big flat line, you can almost see that the returns are going to mimic how the market behaved. But obviously, as we go forward, while we're over here, this particular zigzag up and down can get quite complicated looking in what those percentage or basis point returns are. In this case, the basis point returns are anything from up to 2 basis points up, all the way down to 3 basis points down. So that's the 1 second returns here, and up here are the 200 millisecond returns. They're for different signals, but this is just to give you a sense of what we're looking at. So remember, when building signals, we're actually using historical data, so we can see what actually unfolded in the future, and that's what those yellow shaded areas are. They're sort of showing what happened slightly in the future relative to that point in time. The green line in this chart is what our signal is outputting at that very moment in time. So given only the information at that point in time and backwards, the task of a signal is to come up with a number maybe ranging between like +5 and -5 basis points, although signals that look further into the future might go as far as 50 basis points, 1%, things like that. But the point is, it's going to just be spitting out a number that's positive or negative based on the information we have at hand. And what this chart shows us is that our signal is pretty damn good at telling the future if, when our signal is positive, that shaded area in the background is also positive. Because remember, that shaded area is telling us what actually will be happening in the future relative to this historical data set. So if our signal is positive when the yellow area is positive, well, we're correctly predicting that the future is going to be an upward moving price. Similarly, if the signal's negative when that shaded area is negative, the signal's correctly predicting that the market's going to go down. In the case of these two examples, you can see that the signal quite regularly agrees with the resulting outcome of the market, with the resulting future returns of the market. So while a lot of the time it is correlated to the market or is correctly predicting the future, well, there are instances, let's try find one here, where the signal is predicting the market's going to go down this whole time. The market basically stayed still, and in fact the market went up a little bit in the future there. Our signal the whole time was negative. So signals can also be wrong. It's just really in the balance. How often is the signal correct compared to how often is the signal wrong? And also not just in terms of the direction of positive and negativeness, but also the magnitude of how much it predicts the market might go up versus what the market actually does going up. Also, a big takeaway at this point is to notice most of the time the market's not moving. Look at this, it zigs up and then it's flat for a long time. Then it zigs down, it's flat for a long time. So most of the time, the returns of the market are going to be zero, and that's why you don't see yellow shaded regions all over the place. It's zero returns there. So what should our signal be spitting out during those times? Preferably also zero. You can see this signal is quite noisy. It's hardly ever equal to zero. So in this sense, is this a good signal? It's predicting market's going to go up or down, and the market's actually just staying flat. You're going to see in later episodes this becomes a rather important facet of something to focus on. It really matters how you treat these kinds of data points when it comes to doing the machine learning and the statistics, because there's a lot more of those zeros than there are of actual positive and negative movements in the market. Now, clearly, we're not going to get very far with our signals if the only way we can evaluate them is to look at a 30-second segment of time like we have done here. This signal is going to be running over days or weeks of algo trading. So we're going to have to come up with a better tool for working out whether a signal is potentially a good or a bad one. Examining a signal in this way is great for debugging, seeing if your hunch is right, seeing that the range of the signal is kind of correct. It's really more a visual debugging tool. Think of it that way. If you're a programmer, it's a debugging tool, but it's certainly not an evaluation of the overall goodness of a signal. For that, we're going to have to turn to 2 or 3 weeks of data. You're never going to fit that into this chart. Remember, high frequency trading is a statistics business. We can see that a lot of the time the signal's getting it right, but we can also see it's getting it wrong. So what percentage of the time is it getting it right and wrong, both in terms of direction and in terms of magnitude? Is it getting it right enough of the time? To answer that question, we need to turn to a different type of chart. This chart shows the results of a signal making predictions for every tick over a 2-tick period. There are literally millions of data points in this chart. The blue one is, the blue dots are literally the predictions over the entire 2 weeks, and then overlaid on top of that in orange are the predictions for the last few days. This gives you a sense of whether the signal has behaved completely differently in recent times over long ago times. Sometimes the market will change completely and a signal goes from being completely useless to being very useful, or vice versa. So it's good to just have that sort of visual feedback to your eyes of, hey, this signal's not very stable, or it's very stable over time. Actually, while I say this has millions of data points, it actually subsamples those data points so that I don't completely destroy matplotlib, which is a Python library that I call from C++ using the very excellent, I think it's PyBind library. It's a very good way of embedding Python into your C++ code, so you can take advantage of a lot of the cool data stuff that Python offers while orchestrating and automating it from C++. So looking at the central chart here, what this shows us is on the x-axis is our particular prediction at a given point in time. So maybe this point over here, we're predicting the market's going to go up 6 basis points, and what actually happened a second later, well, on this one is the 200 millisecond chart, the one on the right is the second chart. So we predicted it would go up 6 basis points, but in reality, it only went up 4 basis points. So while the core of the information is contained in the central chart, the charts surrounding the sides are just there to help me look at how many dots are lying in this pile. It's very hard to see when dots are covering each other at this kind of granularity or resolution. So this is just a histogram that basically shows how many dots are in the positive half at that particular x-axis there. So obviously there are going to be a lot more dots or close to zero than there are dots at outliers, whereas over here it's showing, yeah, there's just one dot out here somewhere. Similarly, this one on the right-hand side is showing this right-hand side of the central chart, how many dots are there on that y-axis. It's just a good way of visualizing how many dots. If you could imagine that chart in 3D, you'd be able to look down on the surface. Well, I'm just trying to take a look from the top, bottom, left, right at this XY scatter chart. Keep in mind that on these charts, the counting axis is logarithmic. So there are a ton load more of points around 0 than there are at even -1 or -2. You can see it's like 2 orders of magnitude. We're talking the difference between 10,000 and 100 points here. And that's been subsampled down from millions and millions of data points. So, but the ratio, the order of magnitude is all that you want to keep in mind there. As we said from the previous slide, a lot of data, or a lot of times the market is not moving. So we're going to expect a very high peak around 0, both in what we predict the market's going to be, that's this one along the x-axis, and actually what happened in the market. The market hardly ever moves, but when it does move, big moves are relatively infrequent. But the biggest takeaway here is what we want is when we're predicting positive numbers, i.e. positive x, well, we want the market to have positive returns, i.e. positive y. And when we're predicting negative returns, negative x here, the market should be actually negative returns. The negative y-axis there. So what we're looking for is, in a perfect world, would have a perfect straight 45-degree y equals x line there, that when we predict anything, it goes up. Well, the market goes up exactly that amount. When it goes down, the market goes down. Obviously, we're never going to be perfect. The closer it is to a squishy 45-degree blob, the better your prediction is going to be. These opposite quadrants here are where you're going to get the direction completely wrong. In this bottom right quadrant here, we're predicting the market's going to go up when actually the market went down, and vice versa. But you can see even for this signal, we're getting it right a lot more often than we're getting it wrong, especially if we just take into account the direction of the prediction, not necessarily the magnitude of that prediction. One takeaway though is if you end up with a chart like this that's just a completely round ball, you know you have no predictive power. Like you predict it's going to go up, it actually went down. It sort of ends up being a sphere of data points there. You really do want that flat 45-degree disk. Okay, so enough about the background of building signals. I trust that I've provided enough information now to give you some idea of the kind of signals you want to be building. Are they high-frequency signals, or are they quite long-term signals? But I'm sure by now you're getting pretty excited about knowing, well, what does building a signal actually look like? What are the mechanics? What are the kinds of mechanics that go on into building a signal? I'm going to cover just one signal in this particular video. There are thousands of signals out there, and actually some of the more successful, more exotic signals, they're probably going to take an entire video to themselves. So remember to subscribe and we'll come back to them. I promise you that. But this is where the secret sauce lies in most high-frequency trading companies. It's in the signals, the prediction of the future. So this is where you'll probably be spending the most of your time going forward once you've built your own system. Here's where the most fun is at. It's the most creative, a lot of maths, and it's where you're going to make your money. It's where you differentiate yourself from other traders who are not profitable at all. So let's dive right in. What is going to be the broad thesis for this signal? Well, basically what we're going to do is we're going to look at the current book. And if there are more buyers than sellers, we're going to predict the market's going to go up. There are more people wanting to buy. It's going to be scarcity. Through economics, surely the price is going to go up. And similarly, if there are more sellers than buyers, we're going to predict the price is going to go down. It's a pretty obvious idea, no? Well, yeah and no. Basically, it's all going to come down to the detail. What do we exactly mean by there are more buyers than sellers, or more sellers than buyers? There are literally countless ways we could measure this, and some are going to be more effective than others. The important thing to remember is if everyone's doing the same thing, there's not going to be much trading profit to be had. It's going to be shared amongst all of you. You have to come up with something unique, something that no one else is doing, something that's slightly more predictive, more expressive, more powerfully predicting the future. So in our case, let's do something quite simple, just so we can get the idea across of what it's like to build a signal. So have a look at this order book over here. We've got a best bid at $650 and a best ask at $651. So we might reasonably say the mid of $650.5 is the current market price for this particular asset, for this particular crate of apples. You can clearly see from this book that there are a lot more people wanting to buy apples than there are wanting to sell apples. So what if we base our signal on the concept of what happens if in the next while someone's going to turn up who either wants to buy or sell 5 crates of apples? Well, what's it going to cost to buy 8 apples? Have a look at these. These are all the asks that are available in the market. People are selling apples here. What is it going to cost us to buy 5 apples? Well, we can only buy 1 apple at the price of $6.51. We can only buy another 2 crates of apples at $6.52. There's literally no one even selling them at $6.53. There's some at $6.54, $55, $56. So on average, we're going to have to have spent, well, in total, we're going to have to spend $3,262 for those 5 crates of apples, which is an average of $652.60 per crate of apples. That's what it's going to cost on average to buy 5 crates of apples in the current market. Similarly, what would we receive if we sold 5 crates of apples? Well, in this particular case, there are 8 people out there ready to buy them for $6.50. So we're going to be able to sell them all for $650 a piece. Average price, $650. Simple. So how about we create a signal whose thesis is that the market mid is actually going to rise or fall to match what it would actually be. What is the mid if you were going to buy or sell 5 crates of apples? So what we do is we work out how much it will cost on average to buy apples and cost on average to sell 5 crates of apples. And we just take the average of those to find the mid. So in this case, our smart mid, our signals mid, is going to be slightly higher than the naive mid, which is just, we'll take the best bid and best offer in the market. You can see it's actually 70 cents. There goes my maths. 80 cents higher than the actual naive mid. And mathematically, those cents translate into 12.3 basis points, or if you like to use logs like I do, 12.29 basis points. So in this case, we would say our signal would output 12.29 at this current point in time. That's what these green lines are. It's exactly a signal outputting a number at a certain point in time. Ours would be 12.29, so obviously a lot louder than the signal in this example. And that's it. That's a simple signal. And in fact, this signal was actually quite profitable for a while. I don't know if it is at the moment. It's not really my job to care. I leave that up to the machine learning to do. But yeah, that's a signal. Now, we arbitrarily chose 5 crates of apples for our signal in this example. Why 5 crates? Why not 10 crates? Why not 100 crates? And for example, if you like trading Ethereum USD, well, should you choose $500,000, $5 million, $50 million? These are all open questions. So as you can see, even though we've only built one signal, you can sort of parameterize or tweak that signal in a way that it might respond very differently to the markets. And it actually might be that a certain tweak is useful for short-term horizons, whereas a different tweak is useful for very long-term horizons. Your research is all that's going to be able to tell you whether that's a good or bad idea or whether that actually works. So for example, in the Ethereum US dollar market, maybe 100,000 implied mid, using this kind of example, would be good for like the 200 millisecond, maybe 1 second horizon, whereas you'd probably want to use a 2 million or 5 million or $10 million mid for a 10-second horizon. And often that's where the gold lies. It's not just coming up with the signals, but also putting in the right parameterization, the right tweaks, so that you have enough signals for all the kinds of markets, prediction horizons that you want to be creating. And of course, this is where there is a huge explosion in the number of signals you'll produce. It's not just the signal itself, but also the various parameterizations of that signal. You could create only 100 signals in your entire lifetime, but each of those signals may be able to be tweaked in, I don't know, 3 ways, or maybe if there are 3 ways to tweak it, each of those ways has 3 tweaks you could do. That's 3 to the power of 3, 27 tweaks for just one signal. So you can see how very quickly you can end up with an army of thousands of signals. So obviously we're not going to be able to evaluate the performance of these signals by hand, just even like their performance just for a particular market, but even more importantly, how are you going to combine these signals? Which ones are you going to select to have them work together to be able to even better predict the market? So we're clearly going to have to turn to some automated process, and we're going to use machine learning. And that's what the next episode is going to be about. So now I'm going to get you to do something. I'm only going to drop that next episode about machine learning and how we use machine learning to evaluate signals and to select the signals and to group the signals. I'm only going to drop that video once I've doubled the number of subscribers I have from now. I know it's a bit cheeky to get you to do some of the work, but I mean, I'm not going to teach stuff if no one's going to be listening. So please get your friends, find people who are interested in this topic and get them to subscribe. I'm looking forward to making the next few videos. And with that, fellow hackers and traders, this is Dr. J signing out. I'll see you next time. Ciao.